You watch metals and markets every week, yet still shop with the big guys? Why pay more for your precious metals from the guys who have offices on Wall Street and who bank with JP Morgan? From the basics like eagles, maples, rounds, and bars, to collector coins like Silver Shield and Heroes, SD War Collection, to our exclusive new line of insurance, approved, TL-rated precious metal safes, SD Bullion is what you're looking for. At the lowest prices, period. Guaranteed! Because if you don't hold it, you don't own it. SD Bullion, founded by stackers to help you prepare for what's coming. Shop with the Doc today at sdbullion.com.
This is the Doc Eric Dubin with the SD Weekly Metals and Markets Wrap. Joining us this week, again, is our friend Jay Taylor from miningstocks.com. Great to have you back, Jay. Well, we had a big week in the markets this week with the Swiss National Bank pretty much shocking everyone on Thursday, depegging the franc from the euro after it's been about 3 years. I think 2011, November was when they originally pegged the franc to the euro, and the market is taking that as an imminent sign of massive QE from the ECB coming up here. Gold and silver exploded higher. Silver is up about $1 over the past 24 plus hours, closing in on $18 an ounce, and gold shot through the 1250 level, actually broke above 1280 here trading on Friday, and is closing right around 1275 on Thursday. We had about a 30% move in the franc, so just some extraordinary moves in the markets here on Friday. One of the largest foreign exchange dealers in the world basically went bust. Jefferies is in with a $300 million bailout. CNBC is reporting here Friday afternoon. Quite the week, to say the least, huh, guys?
It certainly is. It's been one of the most dramatic weeks we've seen in quite some time, I would say, and very interesting times. I think that certainly those of us who've been on the long side of the gold market finally feel a little bit of relief, and maybe, just maybe, we've seen the bottoms for gold. It sure looks like it at this point in time. But I mean, the bigger question is what is going on underneath the surface? What is causing all this volatility and turmoil in the markets, and why did the Swiss National Bank decide to pull the plug on its connection with the euro?
Yeah, well, they did telegraph some interesting, foreshadowing of this back in mid-December, because they decided to institute negative interest rates starting, lo and behold, on January 22nd, which is when the ECB meets. So they were clearly preparing for the eventuality of the ECB doing their QE program, and there is a high-level coordination between central bankers, and I think that in this case, a lot of people are speculating that, well, the Swiss are just going on their own, and they're making a decision and basically saying, this is, enough of this Keynesian madness. We're going to take care of our own banking system, and they certainly have their own incentives to, make sure that the Swiss currency just doesn't go into oblivion on the back of the EU's decision to, do further quantitative or really aggressive quantitative easing. Because as we were talking about before we started recording the show, I mean, banking is really the core industry for the Swiss. I mean, they do a lot of different things, and they have great technology, great chocolate, and all that good stuff. But the bottom line is that it's really banking that butters their bread.
Yeah, no question about it, and certainly I think you can sort of understand why they would want to not see their currency debased. If Switzerland, as is known as the attraction for money from all around the world to go as a safe haven, people might start to withdraw their money out of Switzerland if they feel that the Swiss franc is going to go the way of the euro, which is being telegraphed, as you note, for a downward revision in purchasing power. So it makes a lot of sense to me that the Swiss, acting in their own behalf, would do what they're going to do. But I also find it difficult to believe that they would be acting entirely on their own, and there wouldn't have been some conversations with other Swiss bankers, with other central bankers along the way.
Yeah. They had also accumulated about $500 billion worth of euro holdings in the process of selling the Swiss franc try to keep this peg with the euro at 120.
Yeah.
And it was getting to the point where it's approaching 100% of their gross domestic product.
Yeah.
And it's just not tenable. I mean, this whole demonstration this week speaks to the fact that this fiat madness can't go on forever. I mean, when it's Japan for 20 plus years in one corner of the world, and even though they're a large economy, it's quite different than the majority of nations, and their economy is doing what in essence is debasing with a race to the bottom. I mean, there's no way to see any kind of outcome other than tears from something like that, and this definitely does mark the one road sign along the end game, in my opinion. I think that it's showing the cracks of the Keynesian system.
Yeah, that fiat madness cannot go on forever, so one wonders how long it can go on, and as long as it does go on, history shows that the fiat currency actually gains from it. I think that's one of the things that had been driving the U.S. stock market for so long, for quite a while anyway, was, we were probably the best economy in the world. That's not saying much because everybody's sort of really down and out. Where is the growth coming from? Well, if there's any growth at all, and I don't think it's what it's cracked up to be here in the United States, but if there's any growth at all, that's where it's been coming from. And if there's any currency that's stable outside of, well, I guess maybe the Swiss franc now starts to pick up some stability factors, but the U.S. dollar has been the safe haven place to go to, and there's no other place really that can quite compare with it. And I suppose as long as the United States remains the premier global military power, that it can continue on for some time. That, I think, is the key to it. And I suppose there's nobody else with the technological strength that the U.S. has and military strength that the U.S. has to really challenge us militarily. And I think there's some big challenges going on, in the currency markets, and certainly between the BRICS on the one hand and the Anglo-American Empire and its NATO forces on the other. But how long this can go on is the question in my mind. And so I found it very interesting that long about the time, Eric, you were mentioning that, a month or so ago that the Swiss started talking about negative interest rates. Well, that's kind of when when gold actually started to outperform the dollar. And so one wonders if the dollar is the strongest currency in the world, and gold is outperforming the dollar now for the past month. If that might not be the signs, that, at least in the minds of a few people, perhaps some very wealthy and powerful people, perhaps even the likes of the BRIC countries, that maybe the better place to go is out of the dollar, or at least out of other currencies and into gold as well as perhaps the dollar.
Yeah. Yeah, that dynamic's definitely playing out, I think, for the time being. But at the same time, the purchasing power of all currencies, including the dollar vis-a-vis gold, is going to decline, and that is speaking to the fact that gold is actually appreciating in dollar terms too now. And one of the interesting things that'll be on the radar that everyone needs to look at is what's going to happen with the Fed's timetable with respect to their goal of returning to slightly higher interest rates and giving lip service to being more sober. And with all of the deflation trends that are going on now, I think that talk's going to end pretty darn soon. And the Fed has been able to rest on its laurels by playing this kind of rotational game of QE, with Japan picking up the slack after the QE2 program in the United States, but then being very aggressive within the last year. And now the ECB stepping up to the plate. But the economy in the United States is rolling over, and we have all of these various catalysts that are going to really come to bite, with the energy sector falling apart and currency fluctuations creating derivative bombs that'll be going off in the next month or so. I mean, there's a lot of dead bodies laying around that are going to surface and create a lot of turmoil. And the retail numbers were horrible for December, so I mean, it's clear now, even to the people who don't visit Zero Hedge and get most of their news from hanging out around the water cooler in their trading shops or whatever in the Wall Street community, and are kind of oblivious to alternative news sources, that even they are beginning to see that there's a lot of problems, and that speaks to a real questionable time frame with the Fed's goal of trying to tighten up the system. I think they're just going to back off on that entirely, and that all of their discussions about raising interest rates at some point are for naught. It's more jaw-boning than anything.
Yeah, I absolutely agree with you, and it's not only, in my view, not only because of the economy that they can't raise interest rates, but it's also because of the enormous amount of deficit that the U.S. Treasury has, not to mention other companies in the private sector. I mean, one of the things that is, I think we're seeing some real carnage in the equity markets. I don't think anything compared to what we might see into this year. But one of the things that people need to realize is that the margin debt on the stock market was at all-time highs. So, you know, when the margin clerk calls and you have to sell what you're able to sell, not necessarily what you want to sell, some things can happen fairly rapidly. And I would just say that one of the things that I track, just to try to keep an objective view over whether the global monetary system is inflating or deflating, is something I call my inflation-deflation watch. And that is really it's a mixture, non-weighted, non-back-tested means of trying to gauge the global equity markets, and then the key in key sectors, as well as general larger market indices, and then major commodities such as oil and copper, and also look at gold and silver as well in there, and also debt instruments like sovereign debt instrument, well, the U.S. Treasuries primarily. And, you know, we've really flashed a real deflation signal here. A couple of weeks back, we cut through the 3-year moving average, and it's heading very strongly downward, and we're not all that far now from the 5-year moving average. So as long as the equity market stayed up in the U.S., my IDW sort of treaded water. In spite of trillions of dollars of new money that went into the system, we did hit a new high in July of 2011. We came down, and so it was quantitative infinite. According to Bernanke, we would do and pump in as much money as needed forever and ever. And of course, more recently, though, our Federal Reserve guys, our monetary folks, have been trying to suggest that, oh, we're not all that promiscuous. We are sensible people. We will get back to normality. We're going to have that escape velocity from the economy, supposedly. The problem is the escape velocity never comes. And so, yeah, and I think that, honestly, that the numbers that we get out of the government are highly suspect, the BLS, I mean, I don't buy the notion that we only have an inflation rate of 2% or 1.7 or whatever it is supposed to be now, because I know Mrs. Taylor and myself spent our cost of living with health care, with food. Well, of course, you can make the case now energy costs have come down. That's true, and that should have some impact on some of the other things. But the point is the high unemployment. The labor force, the number of people that are in the labor force keeps shrinking back to levels we haven't seen in a couple of decades. So it is not a good picture in the United States. If we're supposed to be the beaming light that and the strength of the global economy, then it's not, you know, it's not really very encouraging, I'm afraid. So I agree. I don't believe they can raise interest rates. I think the Keynesians want to believe their religion. They want to believe that they have it right, and so you know, they keep saying we're getting there, and I guess they put on different rose-colored glasses as need be in order to see what they want to see. But I don't see it. I think that I don't think they can raise rates. I mean, just think what happens to the enormous amount of interest expense that starts to creep into the U.S. Into the Treasury, into the U.S. budget, and then just look at the reaction of Wall Street whenever they've hinted at it. So yeah. I think Wall Street is begging. I mean, like a spoiled little rotten 2-year-old. It's saying we need more monetary cocaine, and unless we get it, we're going to throw a hissy fit. So, and
anytime we get near the 3% rate for 10-year bonds, U.S. bonds, you know, the Fed comes to rescue, and either through job-owning or backdoor buying of bonds, or overtly when it was official that, you know, up to $85 billion a month was going into mortgage back and bond buying.
Yeah.
They push the rates down, and all the deflation scare that's prevailing throughout the consciousness of people in the markets now, doing the dirty work for them, just because everything's kind of falling apart.
Yeah.
I mean, lots of countervailing trends. But I know you're going to be interviewing Axel Merck in a show in the next couple of days, and that's going to be really interesting to get his take as a Swiss national and someone who focuses the predominant focus of his funds on currencies. And traditionally, he's been relatively positive about the euro vis-a-vis the other currencies, and I'm wondering if he's going to be changing his tune at this point, given the fact that Mario is supposedly going to be bringing out his bazooka, and maybe we'll see $500 billion on $1 trillion worth of QE. Who knows? But I think on the 22nd we're going to definitely get an announcement from them, because at this stage of the game, given all that they have said, it would be highly dangerous if they didn't actually get moving. And they did get Germany through legal machinations to basically step aside and permit the ECB to do what they're going to do on January 22nd. So I wonder, what do you think about the future of the euro? I mean, Greece conceivably might even exit the euro, if not the entire economic union, and there's a lot of moving parts here that suggest that we might end up getting a northern euro, with stronger countries like Scandinavian countries and Denmark and Germany banding together, and the quote-unquote pigs kind of being shoved off. Do you think that's something that could happen, and what are your thoughts about the euro?
Yeah, I think that's a very, very good likelihood that you'll see some of the countries that are just not willing to, to see their own capital destroyed. Because let's face it, what the whole global economy is about now is the destruction of capitalism. There's nothing less than that. When you go in and manipulate interest rates to levels way below anything the market would allocate, then essentially what you're doing is destroying the price mechanism. You're destroying price discovery for capital. And what else is that but the destruction of capitalism? And that's what we're doing. We're destroying capital, and we're creating malinvestment, because we're taking assets. We're under with the force of a gun by government. We're essentially forcing people to give what they have to people who don't have anything. And you could understand. I mean, ultimately, if people wake up and smell the coffee, they say, "Well, wait a minute, this is wrong. I can't stand by and let you rape and rob and pillage me. I mean, this is it. I can't do it anymore." And people are going to look after their own interests. So I wouldn't be surprised to see some of those northern countries, doing that. I mean, I just think, the work ethic that the Germans have, the attitudes about things, and the northern Europeans are different than the southern Europeans. I mean, my wife is Portuguese, and they certainly, a lot of fine people, Portuguese people who work very, very hard, but there is a little different mentality about things in some of those southern European countries, and I wouldn't be surprised. I mean, why do we have the euro to start with is a good question, and who's behind that, and what are the motives for all of that? I mean, I think there's a lot of questions that need to be answered with regard to that. I don't have answers to those things, but certainly, why do we have a euro to start with?
And the original thesis was to bring a trade union to lower the odds of war. If countries were finding their interests met through trade, that they would have less incentive to fight and squabble. But it grew so much further than that. I mean, the globalists basically have an objective of making unions amongst countries and whatnot to further their own corporate interests.
Right. For sure, that's the case, and in the process, what they're doing, and seeking to do at least, is to destroy the sovereignty of nations, and that's really what they're all about, is to take away the right of individuals to run their countries, or individual countries to conduct their affairs the way they want, and all the large the TPP and the various trade initiatives that are being set out are really have that as an end result. Whether that's what their intention is, they want to have more power in the hands of fewer and fewer people. I think that's what it's all about. So it's about centralized government rather than than having government closer to the people. And I mean, we had a revolution in 1776 in America, was to give the government back to the people. And now I think, like the frog boiling in the slowly warming water, we have fallen asleep here and have been content with daddy government giving us whatever we wanted or whatever we thought we could get for nothing. And ultimately, you know, we're losing it. We're going to lose our wealth. We're going to lose our. If capital is destroyed, then you lose prosperity. It's as simple as that. I mean, you don't get any wealth from sitting around and not working, and not creating and not inventing things. And I mean, there's a certain amount of incentives that cause people to do things besides monetary incentives. I don't mean to say there's not, but ultimately you have to have profits that grease the wheels that keep things going. And if you destroy that, which I think the central bankers, the Keynesians, which I think are really communist light in their theory, that they're really destroying capitalism globally, and that's what I think is really at risk. And so I guess the question that we have to ask ourselves is, how do we best prepare and defend ourselves and prepare for what we see coming ahead? And that's, I suppose, what we're all trying to do.
I want to transition here in a moment and ask you guys a question that several readers have been asking here today. With the strength we've seen in gold and silver the second half of this week, and particularly today here on Friday, with the big 60-cent move in silver and again the big about $25 move in gold. Typically on a day like this, for those who have watched the metals markets over the last 5 to 10 years, on a day like today, in the afternoon, a lot of those gains will attempt to be kind of worked off a little bit. But we're not seeing that here on Friday. They've spiked higher and they've really plateaued, and we're closing the week at the highs, which is, in my opinion, really significant. But some of the readers are asking, is the implications with this, the Swiss depegging the franc from the euro. We're seeing gold and silver strong along with the dollar. With the dollar soaring, we're not seeing what has been an inverse correlation typically with moves such as this. Have the Swiss, and we were discussing a little bit before the show, has the Swiss National Bank just ended the gold manipulation, or is that a bit too soon to call that?
Well, I certainly think it's too soon to call that. I mean, everything that the ruling elite has going for it would be destroyed if gold were to replace the dollar as money. And they cannot allow that to happen. So, I don't think. As a matter of fact, I said to my good friend David Jensen, I wouldn't be surprised there will be some special meeting among the central bankers this weekend to try to get a handle on this thing. So, no, I think the establishment has to put a stop to a rising price of gold, or at least contain it. Because the last thing they can have, I mean, I think that the fact that we've seen gold outperform the dollar over the last month and the dollar perform all other currencies, that's telling me that at least at the margins there are some people around the world, a few people, the leading thinkers probably, that are starting to say, well, maybe we better get out of the fiat currency system a little bit. Maybe we ought to opt out of the system. And that's fine if just a few people do it. But Lord help the establishment if the masses start to think like that. Then we really will have a destruction of fiat money, and in terms of fiat money, we'll have hyperinflation. At this point in time, what we see is a deflationary impulse, because there's so much debt that cannot be repaid. It is impossible to repay the debt from the cash flow, because we have debt growing exponentially and incomes growing at best, if they're growing at all, in a linear fashion, at a very slow rate of growth globally. So we're running into more. Every time you print more money, you're creating a bigger problem. And every time, at least when you force the interest rates down below market rates, you're creating a bigger problem. But the guys that are on this cocaine, that are benefiting from it, they don't want to give it up. It's a habit that's very hard to break. In fact, they cannot afford to give it up. So I think that we will see them fight as hard as ever. I don't know how they'll come back and do it. But yeah, I mean, I think you can't take anything for granted. As good as this move in gold feels for me, and silver feels for me, and the investments that I have, I mean, I'm always figuring that sooner or later they'll find a way to try to clamp down on it.
Yeah, I agree. And we do see a pattern often that the cartel tends to act more aggressively when momentum cools off a bit, because they realize that they want to get the most bang for their manipulation buck when they dump contracts into the market and so on and so forth. And an interesting wrinkle to all of this is that our markets are actually going to be closed on Monday. So, the way we are closing out the week Friday here, and also what of interest is that gold actually took off at about 6:30 or so, roughly, when the COMEX was beginning to set up an open where speculators have been flowing back into gold, and we've seen that even before this Swiss announcement. It started pretty aggressively as of last week. And then if you compare it to how silver reacted, it took another 3.5 some odd hours before silver really took off today. And that speaks to, in my opinion, the fact that the cartel's just basically backing off today because the momentum into gold and silver was just so hard to fight that they wouldn't get a lot of traction by attacking it just yet. I think that theme is actually going to be with us through next week, because the ECB is going to probably do at least 500 billion worth of euro stimulus, and then later in the week we're going to have the Fed meeting. So it's gonna be tough because sentiment really has flipped. There's a lot of people now that previously were not thinking about gold as safe haven, but now are, and that includes a lot of people on Wall Street that have waken up to the derivatives risk that are growing out of emerging market sovereign bond holdings, where nations have issued a heck of a lot of debt in dollar terms, and with the dollar moving much, much higher, all the interest service on that and their positions overall are really tenuous. And then you add on top of that what's happened into multiple hundreds of billions of dollars worth of junk bond financing in the oil sector now, basically under extreme stress. So the whole deflationary cascade falling domino scenario is now actually something that even mainstream people on Wall Street are thinking about, and all of that's going to give a really strong bid to gold. So even though we're going to constantly see capping and kind of the managed retreat process that I've described a lot of times, as Bill Murphy had coined the phrase, the bottom line is I think we're still going to go higher in the short term, and in the next month and a half or so, we're going to be significantly higher.
Yeah, it kind of feeds on itself because the deflationary forces are coming into play, which means they have to print more and more money faster and faster. And I've kind of always felt that after this big announcement of tapering, and we were going to stop stimulus here in the U.S., when the day arrives when they can't do it and they're going to have to go in with the big bazooka again, that's when there would really be a loss of confidence, and you could really see gold and silver take off. And maybe we're almost at that point where it's impossible for the central bankers to fool people anymore. I don't know.
Yeah, it's an excellent point. And one of the things too that we were talking about before we went on the air was that we've had a pattern of central bankers kind of doing a rotational game where the Fed will be very aggressive early on since the 2008 crash, and then 2011 comes, and the formal QE2 program comes to an end, and there's an intermission, and then Japan steps up to the plate, and then the ECB steps up now. And looking forward, frankly, I think that that rotation is actually not going to be possible anymore, that all of the major central banks will be acting all at once, and that's different. It's a significant change, and because of that change, I think that the switch to realizing gold as the ideal historic hedge against that kind of activity amongst central bankers is going to be front and center. A month or so from now, people will probably be talking about just that, about the fact that there are actions by the Fed giving up its job owning about, we're going to raise interest rates later this year. And in fact, maybe even hinting more often, as they have started to do a little bit already, that we might have to have an even extended longer period of time of zero interest rates, and maybe even at some point, if something happens bad with derivatives blowing up by March or April or what have you in the oil sector, which I think is a reasonable time frame to expect some of that stuff to unfold, that Janet Yellen's going to be tucking her tail between her legs.
Yeah, definitely. I don't, it's hard to see a way out of this for the central bankers, but, God help us, who knows which way, how this is going to end, but it's not going to end well. I think that history shows that whenever countries start printing money without limit, that things end badly, whether it's a deflationary implosion or a hyperinflationary explosion. Either way, it's not good. And really, what it's all about again is the destruction of capitalism, the destruction of capital, and it's redistributing wealth from the people that create it to the people that control it. And it's certainly not what our founding fathers had in mind in 1776, but it's what we've got now.
So, John, is there any interesting retail report as far as consumer demand for gold and silver?
We definitely saw demand roar back to life the second half of the week. Demand has been a bit subdued over the last couple of weeks, at least in comparison to just the epic levels we saw in October and November. But we really have seen demand roar back to life here the second half of the week, with gold and silver jumping higher. As I mentioned before, you can see it with how gold and silver are trading into the close. It doesn't look like anybody wants to be short gold this weekend for sure.
Interesting. Yeah. Well, I'd say that might be the time that the powers that be try to pull the rug out from under our feet, though. Who knows?
Well, before we wrap, Jay, if you want to just let the listeners know where they can check out your fine work.
Yeah, they can go to, the best place to go to is J Taylor Media. That's JAYTAYLOR media.com, and that's where they can access my weekly radio show. It's a live show, but at Voice America, but the podcasts are there, as well as I do a weekly podcast with David Jensen talking about the fundamentals of the gold markets, and then I also have Daniel McAdams of the Ron Paul Institute for Peace and Prosperity with me to talk about what's really going on in the geopolitical arena as opposed to what our mainstream media is telling us is happening. So that's the best place to go to. My newsletter more directly is at miningstocks.com. But either place is a place to go to catch up with what I do.
All right, well, it's great to have you back again, Jay.
And you're going to be at Cambridge House this weekend, right?
Yeah, I'll be at the Cambridge House this weekend. I have a workshop there and looking to talk to lots of mining companies. I can see that I'm going to be extremely busy because there's a lot of people to talk to, and now, honestly, I actually feel like talking to them again because it looks like maybe we could actually make some money in this sector again. I don't know. Maybe my hopes are up, but we've had a 3.5-4 year bear market. It's been pretty difficult. So, the price action of the last few weeks have been very encouraging, to say the least. So, yeah, I'll be I think there's lots of great stories out there. And again, the price, the value of gold relative to oil and relative to other commodities, I think is a bright spot also for the mining companies. We should start to see some improvement, I think, in mining company earnings going forward. So I'm really enthused about visiting and talking to some of these people again.
Well, certainly we can expect volatility to continue next week, over the next couple of weeks with the ECB meeting and the expected QE, and then following that, the Fed's meeting as well. So we'll wrap up this week's show there. For the Doc, Eric Dubin, and Jay Taylor, thanks for tuning in to this week's SD Weekly Metals and Markets.
Those individuals who are in charge of monetary policy around the world, I think they're very much aware of what is coming. When I've asked Federal Reserve Chairman in the committee about this, they never said, no, that's not going to happen. They used the word orderly. As long as it's orderly, it seems to be okay.